Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, where my guest is Ashley O'Connor, Head of Investment Strategy at Invesco Australia. Welcome, Ashley.
Thanks, pleasure to be here.
Ashley, you've been an advocate for senior secured loans for a long time. What's the combination of attributes within the sub-asset class that really appeals to you so much?
Yeah, so my history with the asset class dates pre-GFC when I was working at Frontier Advisors, which advises on about 400 billion of institutional assets at the time, and I was head of debt there. And of all the asset classes that I looked at across the debt spectrum, the one I'm most passionate about is senior secured loans, where I had the opportunity to research about 20 different specialist managers and co-wrote a white paper on the benefits of the asset class for Frontier's clients and help them build their allocations coming out of the GFC, which was a fantastic buying opportunity in the asset class. I'm still very passionate about the current buying opportunity based on the current income that's available and also the pricing of the asset class, which we can talk in a bit. But in terms of to your question, the benefits of the asset class, the reason loans can be a great complement to traditional bonds is really threefold. You've got a high level of stable monthly income. You've got the fact that they are floating rate, meaning interest or income rises as interest rates rise, providing a hedge against inflation. And you're at the safest part of the capital structure. There can also be a great complement to domestic credit exposures given the diversity of the opportunity set by industry and issuer, the fact that it's a highly liquid market and it's been going for over 30 years, so you know what to expect.
But if senior secured loans are sub-investment grade, are you implying that they can actually be safer than securities that are rated higher? Take us through how that works.
Yeah, well, let's talk about why they're sub-investment grade. In many instances, these are really well-established businesses and globally recognised brands that you'd be familiar with, but they may be going through some sort of restructure or acquisition that requires them to have a certain amount of debt in their capital structure, and the amount of debt that they have results in them being classified as sub-investment grade. But as a senior secured loan investor, you're at the safest part of the capital structure, secured against the assets of the business and first right to be repaid. So in that regard, you're effectively, in the case of corporate bonds and government bonds, you're really the dominant contribution towards risk in those investments is interest rate risk. Whereas in senior secured loans, you are exposed to the corporate credit risk element of it. Because of the senior security, it's classified as a low risk asset class.
Do the attributes you really like about senior secured loans hold true in all environments, all weather? Let's look at late 2023, stubbornly high inflation, potential for synchronised global recession, possibly further tightening to come. How's the subsector positioned in that environment?
Yeah, well, I'd argue all those attributes that I talked about are highly relevant in this environment. So the high level of income, this asset class has benefited greatly from being floating rate. So as interest rates have risen over the last year or so, the coupon or income from these loans has risen in lockstep with that. And so now you've got coupons that are above 9% in the asset class. And in terms of the all-in yield for a 3-year view, you're talking about yields above 10%. But a decent active manager can quite comfortably put together a diversified portfolio that's likely to yield, in the order of 13% over a 3-year view, which is quite compelling. And so I would also argue that being senior secured when you're going into a potential recession is highly valuable, having that security and safety in the capital structure. And in these sort of environments, you also want to be diversified across a number of industries and issuers, which is a great benefit to the asset class. You also ideally like the idea of being liquid, and this is a proven asset class with daily liquidity and daily pricing. And as an investor, coming back to the point around how it's likely to behave, with over 30 years of history, you can have comfort around how it's likely to perform. In terms of current pricing, currently it's 95 cents in the dollar. And so although we are expecting an increase in defaults off a current low level, the reality is the market's already priced in a recession-style default event. And if anything, pricing is cheap because we don't think defaults will reach the levels that are already priced in by the market.
So what about the default statistics that investors can reasonably expect through the cycle, and also with reference to where we are now? Can they expect that statistic to start to rise?
Yeah, so average historical default rates over the last 22 years are about 2.7% per annum, which may sound high, it's certainly higher than investment grade, but the important caveat to that is that recovery rates in default have averaged about 65% through that 22-year period. So what that means is your actual credit loss per annum is only about 1%, which is quite modest when you consider that the average spread above risk-free sort of cash rates through that time period is about 4.7%. So you're getting very well compensated for the credit risk you're taking on in this asset class. In terms of current spreads, they're above historical averages, so you're getting about 5.7% above the risk-free rate at the moment, and that's because the market's pricing in elevated defaults. Defaults over the last 12 months have been 1.75%, so below the historical average. Rating agencies expect that to rise to 3 to 3.5%. We think it's going to be a bit higher than that, about 4 to 4.5% defaults. But the current market price at 95 cents in the dollar is implying a default rate of about 5.3%, which is higher than the rating agencies expect it to go and higher than we expect it to go. So I come back to that point. The market has already priced in a recession-style default event. So if anything, we think it's on the cheaper side, given we don't expect defaults to get to that level.
So where in the portfolio should investors place an allocation to senior secured loans? I suppose I'm asking, flipped around, what job are they asking the sub-asset class to do for them?
Yeah, so if I go back to my days at Frontier as head of debt in terms of what we're advising the institutional asset owners, considered it a mid-risk asset class, about 50% growth, 50% defensive, and that's the way that institutions think about it all the way to today. In wholesale, that's more challenging, where things either have to fit in growth or defensive. If that's the case, this is definitely more defensive than it is growth. So we see wholesale investors putting it in the defensive asset class, and we see it being used as a core allocation both within diversified portfolios and income portfolios. So if you think about it from a diversified portfolio perspective, the role it's playing is a diversifier relative to your fixed rate and your government bond exposures. Typically would be funded from fixed income and equities. If you're looking at an income focused portfolio, again, it's about generating a complementary and high level of income relative to other forms of income. That might be equities or hybrids or whatever, or bonds. And in an income portfolio, it would typically be funded from fixed income and hybrids.
Ashley, as government bonds have really come back, they're back in town in 2023, offering reasonably competitive yields, certainly a lot better than in recent years. So has that detracted from people's willingness to go into senior secured, given that 4s and 5s are achievable in the safer ends of the fixed income spectrum?
Yeah, look, I mean, I see government bonds, investment grade bonds and senior secured loans as all playing a role within a diversified portfolio through the cycle. Certainly there's times you want to be over or underweight various segments, but yeah, sure, government bond yields may be up at 4 or 5% type territory. Senior secured loans are north of 10%, and a good manager can get a portfolio diversified together to generate 13% yields over a 3-year view. And that's sort of about double investment grade yields and nearly triple government bond and treasury yields. And so I would argue that's still very compelling in an asset class that provides diversification benefits.
Is senior secured loans still a highly US-centric market?
So the market is predominantly the US. It's sort of typically a manager will have sort of 80 to 90% allocated to the US, but can have up to about 25% in Europe. So the US is a larger, more established market, but both are highly liquid established markets. But that's generally the opportunity set across the US and Europe.
It's interesting in this conversation, Ashley, I've used the term sub-asset class, you've used the term asset class. So is that the way senior secured loans is thought of these days, really as a discrete asset class with its own set of characteristics?
Well, I think you're right to call it sub-asset class within the debt spectrum, but I certainly view it as, given how complementary it is, with that sort of unique set of complementary characteristics that it can bring to a portfolio, I do see it as a distinct allocation. And so I think you want to be really clear about how much you want in floating rate senior secured loans, which is pretty much pure corporate credit risk, versus how much you want in fixed rate government or investment grade bonds. Whether you do that in the same sector or as a separate sector, like many of my clients back in my Frontier days had a separate defensive or floating rate credit bucket that they put it in. It's about whether or not it plays a role in the overall portfolio context, and I believe that it does. So then you just say, well, do you want to put it within the fixed income sector, even though it's not fixed income, and have it as a sub-allocation, or have it as a separate dedicated allocation within an income portfolio?
And in the Australian investment marketplace, let's take it from institutional to wholesale and retail, have investors here grasped this opportunity anywhere near the extent that you would probably say they should?
Institutionally, yes. Certainly pre-GFC, there was a couple of institutional asset owners who are invested in the asset class, even though it dates back 30 plus years. In Australia, the take-up started sort of pre-GFC. And then given the buying opportunity in the GFC, there was quite a lot of institutions that have done it on a specialist basis. Some still hold it, some do it as part of a multi-sector allocation. But I think it's certainly underrepresented in the wholesale market without a doubt. And so this is a huge opportunity set. It's a US $1.8 trillion market, as I mentioned, a couple of thousand different corporates to choose from. And it actually represents about 16% of the US corporate credit market. And the reality is that a typical multi-sector or diversified bond manager does not have an exposure to this asset class. In the case of a diversified bond manager, typically benchmarked against a fixed rate index, whether it be the global aggregate or the UBS composite index, they're not likely to take an off-benchmark risk that includes floating rate and sub-investment grade corporates. And so it is an asset class where if you believe in that, the appeal of that set of characteristics that it offers and the diversification that it offers, it's best done in a specialist way with a specialist active manager.
This has been INDepth, talking to Ashley O'Connor of Invesco Australia. Thank you, Ashley.
Thanks, James. Been a pleasure.